Hello everyone. So today we will be looking at fifth class, and so here's your specification. Um, Up until the last class, we have covered the learning outcomes 1, 2, 3, 4, and 5. Okay, sorry, it's just until 4. So today we will be looking at the learning outcome 5. So I'm going to take you guys through the presentation covering the learning outcome 5. So let's see what we're going to look at the learning outcome 5 here. It's going to be about the sources of finance because that is one of the very important elements. Without funding, without finances, it's quite hard for any business to operate. So that we will be looking at today. And let's look at the assessment criteria in here. So it's about explain the sources of finance available and then the risks involved. We have to be looking at the risks involved in the range of sources of finance because when it comes to the businesses operating, they cannot go ahead with any sort of funding or any sort of finance without analyzing the risk involved, because if they go ahead in that sense, there would be problems in repaying that back. So there is a concern there. So as a result, the risk involved should be understood, analyzed, and then finally a decision has to be made whether the finance taken, the funds that are taken are able to be repaid. If that is so, you can go ahead with it. But however, if that is not the case, then you can't go ahead with the relevant finances. So it is very important that the risk is assessed and after that a decision is made. Okay, and then you'll also be looking at the costs involved in managing the global risk. So global risk, when we consider global risk, we will be looking at the international part of it, because international part of it meaning like you have a local operation but then you're also operating internationally. So in that case, we will be looking at the global risk elements. What would be the global risk in terms of finances and so and forth, right? So we will be looking at that concept here. So these are the contents that we will be looking at. Sources of finance, the definitions, and then the internal and external source of finance. So here are a few that they've mentioned, actually a lot. Loans, debentures, mortgages, retained earnings, that is from the organization itself, government sources, government funds, that those are which provided to the businesses, and shares, preference shares, ordinary shares, there are shares like that, and then financial risks associated with using different sources of finance. So these are the things that would cover the learning outcome 5 and that we would be looking at. Okay, so today mainly we always take time, like a learning outcome cannot be covered in a day, so we would actually take like 2 days or so. So when looking at the learning outcome 5, today I'm going to mainly focus on the sources of finance, the types and the sources of finance, because there are quite a few that I wanted to discuss. So we will be mainly looking at the types of source of finance, which could be internal and external. Okay, so today that will be the main focus. Right, so let's move on to session. Right, so this is our main lesson. So in this, we so this is basically what the specification says as well. So this chapter will help you identify the appropriate sources of finance and to evaluate the risk involved and the cost and the suitable techniques in managing global risk. So upon completion of this lesson, you'll be able to identify the sources of finance available. You'll be knowing what are the different types of source of finance in terms of short term and long term, and which would be suitable for the different kinds of organization. Can be small scale enterprises, large scale enterprises. So you'll be able to identify those, and then you'll be able to evaluate the risks involved in the identified sources of finance and the mitigation techniques, because it's always good to learn about the mitigation techniques. It's not just about, you know, understanding the risk involved only, but then you should also be you should also know to identify how it could be mitigated, because that's one of the very important elements. You know the risk, you know what it is, but then if you do not know the mitigation strategies, that is a problem. So you need to understand the mitigation techniques, and you'll be also looking at the global risks involved in terms of finances, and then explains the suitability of techniques identified to manage a global risk. So we're also looking at the mitigation techniques of global risk and the cost involved in managing the global risk, right? Because when there is a risk, there is also management techniques or management strategies. But however, it does not come without any cost. There would be at least a small portion of the cost. So that is something we will be looking at too, right? So this is about this current unit that we will be looking at, current learning outcome in the unit that we are going ahead with. So these are the main topics: the sources of finance, the risk involved, the cost of capital, the global risk, risk mitigation techniques, exchange rates, foreign exchange rate risk, and interest rates. So these are things that we will be covering in this particular lesson. Okay, right. Let's go ahead with our lesson. Before that, right. So let's look at this section, the sources of finance. So this is just beginning of it. So I'm gonna read through this section for you guys. When it comes to financing, there are various sources available for businesses providing different benefits and costs. So it's just not the same. Uh, Depending on the type of business, maybe the growth element, the concept of the business, all those things will decide upon what sort of a financing that you are going ahead with. For example, if it is a small scale, very small scale organization, right? If it is a very small scale organization, you do not have to worry about the funding or financing for too much, because you could always fund it maybe by yourself, or you could fund it maybe um, to the family, because if it's an organization that is developed with family and friends, so in that case, that funding would be enough. You don't have to go into external where you have to go ahead with, asking for a loan, a bank loan, or some sort of debt or something like that. So the type of business is a very important concept when it comes to considering the sources of finance. Also, it is important to carefully evaluate the specific requirements and the sources available to select that best suits the need of the business. So it is really important to carefully evaluate. So you need to understand the pros and cons. You cannot say, okay, I'm going ahead with a loan, because you have to make sure if you are going ahead with a loan, you have to make sure whether you are able to repay the loan. Only in that instance, you will be able to go ahead with it. If you take a loan and if you cannot repay it, that's going to cause very big trouble, because you can't even run your business, right? Your expenses more, so you can't pay it back. Your loan amount with the interest charges are going to be high. When it hikes up, you won't be able to do anything. So the management will be a problem. So with all these things considering as a business, so when I always explain, I tell you guys, put yourself as the business person and understand. So you'll be able to better understand the concept. Okay. So again, so it is important to carefully evaluate the specific requirements and the sources available to select the best that suits and the need for the business. Okay. For most of the businesses, raising funds for business startups, expansion, and development can be crucial for the prospering of the business. It's kind of a crucial factor, because also when it comes to loans in businesses, or even if you are trying to get a loan from a friend or anything as such, it's not really easy, because they would always try to evaluate your strength of paying it back. Not just for, I'm not just talking about the financial institutions, but even if you go and ask your friends or family, they're going to analyze the same thing, whether you are a person who would repay it, right? So it's very important in that sense. So it is important for any business to understand the various sources of finance available and how appropriate it is in relation to the needs of the business. So you need to understand the various sources of finance available and how important it is to your business. To the maximum, you try to avoid taking money from outside, which would result in you paying it back sometime later with an interest charge. The maximum you avoid, it's good. However, there are circumstances where you cannot avoid. So in such instances, it is okay to go ahead with, but then you need to analyze. You need to understand the concept. You need to analyze the pros and cons. Only then you can make your decision. Okay. So here are some of the criteria for choosing between sources of finances. So first comes is the cost, repaying money, the cost, extra cost involved, the duration, whether you're going to repay it within a short period of time or it's a long-term loan, it's going to take like 10 to 15 years. So that's going to be a problem, right? Because you need that, that's a lot of commitment. So you need to be aware also, if it is like a major amount for a month, you need to pay up to like, maybe we say 50,000 pounds or 70,000 pounds or some for a month, I'm talking about. So in that case, it's going to be a major problem if you are going into a contract which is of longer term. That's a longer term commitment, right? And the term structure of interest rates, if it's a fixed interest rate or if it's a floating interest rate, because if it's a fixed interest rate, you are quite clear with the concept that, okay, like this is the amount it is and you are going to pay this forever. However, if it's a floating interest rate, there'll be a problem in the future where the interest rates going up and down. So obviously, if it goes up, maybe due to inflation or economic fall down, or as such, that's gonna, increase the amount you have to pay. So that is a problem, right? So you need to be aware of that. And also the gearing and accessibility. So these are some of the very important points that a person has to take into consideration when it comes to deciding upon the source of finance they would want to go ahead with in starting up their business or going ahead with a development or a growth in the business. Okay, so this is a very important concept. We're starting off with this. We're going to discuss about the different types of short and long-term finances that's available. But in discussing that, you will understand the different types available, but it's very important for you to understand um, the reasons behind it and the importance of choosing, and the points which are important to be considered before you choosing up a finance method. Okay, so it's very important that you make yourself understand this is not just important for your, assignment work, or it's just because you're studying this level you have to understand it. It's not just because of that. Maybe you have a business and it can be useful for you, or even in your personal lives, because it's not that sometimes you also tend to go short of money, and then you want to get a personal loan. It's just not for a business, but then you have something coming up, and then you need a personal loan. Of course those things are available, so you need to really understand these criteria so that you know whether it is suitable or not. So it's very important that you understand it. So it's both important for your professional as well as your personal lives. Okay. Right. So these are the sources of finance. We have short-term finances and we have long-term finances. So short-term, as the word suggests, it's short and doesn't go on for a longer period. Maybe we say an year or two or something like that. Long-term finance is a very long term, and it's a kind of liability as well. It can go up to like more than 10 years or 20 years, it can go up to that. So that's really long. So when it comes to short-term finances, under the short-term finances, you have overdraft, which is often taken, business people do that. They often take these overdrafts, and when they don't have such money in the banks or something, they take an overdraft which is for a very short period and they have to pay back. And but however, it has a greater interest rate charged. Okay, so that needs people need to be mindful of that. So that's the trick there. The banks are willing to give an overdraft, but then of course a shorter period of return is needed with a high interest rate, right? So that is there. And then you have short-term loans, and you have trade credits, you have short-term operating finance, bills purchasing or discounting, factoring and invoice discounting, indirect or non-funding sources. So these are some of the short-term finances. So let's look at the long-term sources of finance. Equity finance, debt finance, preference shares, long-term finance, lease, and venture capital. So these are some of the short-term and long-term finances. Let's now look at each and every one. Okay, so let's go ahead with the short-term finance. First will be the overdrafts. Bank give an extended credit facility through current accounts. So businesses are supposed to have current accounts. Interest is charged on the amount withdrawn and not on the limit granted to withdraw as overdraft. Cost of overdraft is calculated as the cost equals overdrawn amount into the interest rate, and one, you deduct the interest rate. Okay, so this is how the calculation is done. However, this calculation we cannot guarantee because it differs from one bank to another. There would be certain things involved inside, so we cannot actually do the calculations ourselves. But of course, if calculations are asked to be done, this would be the standard format that you can follow. But however, there will be certain changes when it comes to from one bank to another. Okay, so this is basically what the overdraft is, right? So like I said earlier, the overdrafts are a very an easy thing because the businesses are able to take up any time the credit facility at any time, because sometimes it's not really possible to wait for a longer period for the businesses when they are short of cash. So overdraft is something really good, but however, it's good to avoid. Good to avoid meaning sometimes the businesses cannot avoid, but however, it can be with time controlled in terms of having a proper reserves, right? So that is one of the strategies, because you have a finance department, so it's you can always work through with them. So it's always important to have that aside. But however, overdraft is a short-term finance and that is readily available to any business, right? And then let's look at the short-term loan. So, like its name suggests, short-term loans are ideal ways to overcome short-term financial needs. These loans are short-term in nature, usually no longer than 1 year. Okay, so it's between 1 year or less. However, there are also loans that are provided, for 2 years, 3 years. For example, of course, if you have, online banking systems, you would have experienced that, um, which where you can do a fixed deposit and then you can take your loan maybe to like 3 years or so, something like that. But then you'll have to repay with an interest charge. That's a short term, but of course you have an FD out, the fixed deposit out there. But that is going to be a safer zone because you're not losing much bigger money at the end of the day, right? So, and also they can be for short period as 90 to 120 days to as long as 1 to 3 years. The cost of these loans is calculated after removing tax effect from the normal interest rate. Okay, so these are the concepts when it comes to short-term loans. Right, so this is about trade credit. Credit available from suppliers in one of the easiest and cheapest sources of finance. The main advantage here is that interest is not usually charged unless any default is made by the company. So these are trade credits given when it comes to, like, the purchasing of things or any sorts of, you are purchasing something from your suppliers or things like that. So what they would do is they would provide you a trade credit. You don't have to immediately pay up and then get the product. However, there is a trade credit period provided. So within that range, you can do your business and then you can work out things and then you can slowly pay them back. Okay. So the best part here is there is no interest charged, unlike in the banks. But then, of course, if you have if there are any default is made by the company, you just can't return it back. But of course, you need to, pay something out of that. So that is about the trade credit. And then next would be short-term operating lease. Lease is an contractual arrangement where the organization obtains the use of a certain asset from a leasing company for which it agrees to make a series of periodic payments called rentals. In this regard, it is the operating lease that functions as a short term of finance, which is usually arranged for 1 year. This equates to renting an asset, and lease rentals are tax deductible. Right. So this is about the lease agreements. To some extent, the majority of the firms would go ahead with a short-term operating lease because um, this equates to renting an asset, and lease rentals are tax deductible. So there's some sort of benefits out there, and then it does not have a major impact when it comes to greatly long-term liabilities or long-term loans. So in that case, it is okay. Short-term operating lease is about that. Next would be bill purchasing or discounting. Okay. One second, guys. Okay, so let's look at bills purchasing or discounting. The credit sales bills payable within a period not exceeding 90 days are discounted by banks to the current account of the seller to reduce the risk of overdraft repayments or overdrafts being used by companies for non-productive purposes. Right, so this is a good way of paying it back, because if not, there would be a chance that it's being held on. So this is something that is that would work when it comes to businesses. And then we have factoring and invoice discounting. Factoring is the outsourcing of the credit control department to a factoring company. That is, the debts are effectively sold to the factor, and the factor takes the responsibility of collecting the debt for a fee. So you as a business, you have many receivables to come in, right? You as a business, you given credits to the people, and they are supposed to pay you back the money sometime later. So in that sense, what happens is, you can't, if you are not in a position to go behind someone and go behind your receivables and get the money back, you're going to move on to a factoring company. You're going to give all the details, and they will follow up for you and get the amounts. Okay, get the receivables, and not letting it to move into bad debts. That's the overall goal here. Okay, so that's about financing, and that's one of the methods. So factoring and invoice discounting is that. Factoring, I explained to you. So that is about that is where the business would see the accounts receivables, and then sometimes they would even they would not even want it back. In case you see there is a short term there is a short term liquidity need there, and then you have to settle it, right? But you don't know, there would be different ways of it. This is one of the ways. You would just pass on your receivables, although it's not liquid cash currently, but then this is something that would turn into cash sometime later. So you would pass on your receivables to the you would pass on in a way that it would fill up the gap of the short-term liabilities, right? So that also could be one of the methods. And then we have invoice discounting. Invoice discounting is a method of raising finance against the security of receivables without using sales ledger administration of a factor. This is a part of the service provided by factoring companies, but there are specialized invoice discounting companies. The key advantage here is that it is a confidential service and the customer need not know about it, and the money is repayable when the debt is cleared. Okay, so this is also something that's related to factoring, but then here the customer details are not passed on, and then when it is repayable, the debt will be cleared, right? So this is also a part of short-term source of finance. Okay. So this is about the letter of credit, indirect or non-funding sources. These financing sources do not involve the borrower receiving the money. Okay. Letter of credit is one of this source. Here the bank will issue a letter of credit to its client. The letter of credit states that the bank will make the payments to the supplier if the buyer failed to do so, thereby allowing its client to involve in trading through its reputation or credibility. Letter of credits are normally used in import and export trade, and the bank will make the charges from the clients for its service. So this is something the banks are actually taking up the responsibility that we would pay if in case the buyer doesn't pay it. So that is actually a credit, it's actually a valuable thing for an organization who takes that and give. However, there is a charge obtained. But however, in this case, the banks does not just give it. However, they would have uh, seen the annual reports and they would have operated for a considerable amount of time, and only then this will be given. Okay. So that is about the indirect or non-funding sources. Right. So we will be looking at the long-term finances. So all this time we looked at the short-term finances, and now we will be going ahead with the long-term finances that are available for businesses. Right. So we will look at the long-term finances from here. So first we will be looking at equity finance, so which is the ordinary shares. Like I told before, there are different shares, which is preference shares, ordinary shares, and then that could be even further broken down. So we will look at ordinary shares here. These represent the equity ownership of a company and is the smallest part from a company's issued share capital. An ordinary share gives right to its owners to share in the company's profits and to vote at a general meeting of the company. They don't have predetermined dividends, that is, where the company will pay them based on the earnings of the company. They are unsecured creditors of the company, meaning they are last in the queue if the business goes into liquidation. The cost of equity is not a tax deductible expenditure. It is an appropriate of post-tax profits to the shareholders. Okay, so this is a bit of problematic situation because you see when it's about unsecured creditors, right? In case where the businesses go into bankruptcy, into liquidation, they'll be the last in the queue to be repaid. So that is of a concern. But however, there are of course benefits of having ordinary shares because they have the voting rights and they are also part of the business's decision making and the owners to share in the company's profits. So of course there are immense benefits, but on the same note, there could also be problems in terms of, when you go into liquidation, when your business goes into liquidation, you have a problem of getting back your money in. So that is a problem here, right? So that's about the ordinary shares. Right. Cost of equity. Cost of equity is calculated based on two techniques. So first, calculating cost of equity using dividend valuation over growth model, DVM over DGM. So that is this calculation. This is a formula used, and then you have the explanation for each category in here, right? And this would be the second, the cost of equity using capital asset pricing model, which is the CAPM model. So that formula is this, and then for each and everything, every element here, there is a reasoning provided here for your reference, okay? So this will be the formula for the second calculation of the cost of equity. You guys can take this down too if you want to. So I'm going to give some time. I'm going to give some time for the first equation here, so you all can take it down. Maybe have a screenshot or something. Then you guys can take this too. Right. Okay, so let's look at the capital asset pricing model here. Capital asset pricing model is a model that describes the relationship between risks and expected return, which is used in the pricing of risky securities. Okay, so it will actually help you describe, help you understand the relationship between the risk and expected return as of the risky securities. However, much investors diversify the investments. It is not possible to get rid of all the risks, but for taking such risks when investing, they deserve a rate of return, and that is why CAPM will help to calculate investment risk and what return on investment they should expect. So although there are problems that's being experienced as a result of these such risks, there are certain risks that you can't get rid of, but Taking such risks when investing also will result in a good rate of return. So in order to calculate that, the CAPM will help you to understand the level of risk and then to calculate the returns that they should expect. Okay. So this is about debt financing. Debt financing is obtained through borrowing where the company has to pay a fixed interest. Okay, so there is a fixed interest involved. The interest is payable whether or not the company makes profit and is tax deductible, right? So that you have, it's like the interest is payable whether or not the company makes the profit and is tax deductible. If the company goes into liquidation, debt will be paid before anything is settled to equity holders. Beneficial. The ranking of repayment of debt depends upon the kind of security the lenders hold. Therefore, debt carries a lower risk than equity. That's quite impressive. So types of debt finance would be loan stock or debentures, deep discount bonds and zero coupon bonds, institutional debt and bank finance, euro bonds, convertible bonds and warrants. So this has quite a bit of benefits, and these are the types of debt finance. If you are involved in one of these, you can actually experience those, right? Okay, next, loan stock. Loan stock is a written acknowledgement of a debt by a company, normally containing provisions as to payment of interest and terms of payment of principal. So that's about the loan stock. So it's not something that you can have in hand, but then it's a written acknowledgement. Debentures are similar, but they are not backed by collaterals, but reputation and creditworthiness of the company. Mainly issued by large companies to raise finance, debentures are similar to bonds, but their conditions of securitization differs. So the security features differs, and in practice, their differences is not much notified and sometimes identified as bonds. Although it is, there are quite differences, but it is not highly visible is what they mean. And then there is deep discount bonds. These are bonds issued at a higher or deep discount and are redeemed at par value at a premium. So this is also one type of long-term finance. Then we have zero coupon bonds. Bonds with higher capital gains and lower interest rate in comparison to deep discount bonds. Investors will not get any inflows before maturity. So there's nothing coming in before the maturity stage, because when you are buying, when you have such things, you will have a maturity stage here. So in between, you're not getting anything as dividends. Investors will not get any inflows before maturity, and if they require cash, they will have to sell their bonds at the ruling market rate. Okay, so there's nothing involved in between. They purchase and they sell and they get their profits. There's nothing in between that they could enjoy. Then you have institutional debt and bank finance. These are loans provided by banks and financial institutions. Okay, this is a basic concept. Euro bonds, these are bonds denominated in foreign currency, different from that of the country in which they are issued, and they are outside the control of the country in whose currency they are denominated. So this is not something within the zone, but then outside the zone, and the controlling power is not within and outside. It depends on the currency in which they actually get it. So that's where the controlling power lies. Okay, and then we have preference shares here, right? So preference shares, these are shares which gives the shareholder a fixed dividend, but not usually voting rights. So see, this is the difference between ordinary shares and then the preference shares. In the ordinary shares, there are voting rights provided, but here there is a fixed dividend provided, but not usually the voting rights are given at company meetings. They are categorized as equity or debt based on the underlying feature of the shares. If the shares tend to give a predetermined maturity rate, the dividend rate, it is then more suitable to classify it as a debt. Preference shares are usually irredeemable. The cost of irredeemable preference shares is calculated as follows. So they are irredeemable, and the cost of irredeemable preference shares are calculated as follows. That is this. If preference shares are redeemable, cost of shares calculated using the IRR, that is the internal rate of return method, but the tax adjustment will not be required as dividend is not tax deductible. Okay, so that's about the preference shares. Bank debt or non-tradable debt. Bank and other non-tradable debt doesn't have a market value since they are non-tradable securities. Okay, because they are non-tradable in the market, they do not have a market value because you can't trade it again. Only if you have for something a market value, you can trade it again because it doesn't have. So it's a non-tradable security. Thereby, market values will not be applicable to these types of debts because they are non-tradable. Okay. In long-term finance, lease, the lessor long-term finance lease, the lessor provides money to purchase the asset. The lessee has to settle the principal amount and a predetermined interest annually. So this is about the lease agreement which we saw previously. The next would be venture capital. This is the capital but by investors in a relatively more risky business. They provide risk-bearing capital and usually in the form of participation in equity to companies with high growth potential. Venture capitalists provide startup and late stage growth finance, usually for smaller firms. So this involves relatively more risky businesses, and then it's usually in the form of participation in equity to companies with growth that has growth potential. And venture capitalists provide startup and late stage growth because there's a high risk involved, and usually for smaller firms, okay, because it cannot cope up with. So next we'll be looking at the risks involved, the sources of finance, okay. However, I'm not going to continue with this in this class. So we will be looking at the risks involved in the next class, and we will aim to finish the learning outcome by the next class. So we will continue with this session in the next class, going ahead with the risks involved, guys. Okay, so today's session is about the importance of understanding the sources of finance, the criteria involved when you are selecting a source of finance. What are the things that you have to consider? Okay, either it be or your professional business or even in terms of your personal things coming up, you should be very careful when you are going ahead with, or when you are deciding of which source of finance you would want. You should be able to, the main thing out of everything, main thing would be whether you are able to repay it back. Okay, that's the foremost important thing. And then we've also looked at the different types of finances, focusing towards the short-term finances and long-term finances. So we discussed about several things there. So having gone through that, next will be the risks involved in the source of finance, and we will go ahead with that. And for that, we will continue with the next class. Okay, so I will see you guys in the next class.